Hello, today we are going to talk about SEC and payment for order flow. Robinhood, the ultra-popular brokerage, helped herald a new age of commission-free trading by pushing established financial institutions, such Charles Schwab and Fido, to follow suit. Unfortunately, there's nothing free about a free lunch. In an age of commission-free trade, brokers still had to find ways to make money on their customers' trades. One of the most profitable, and controversial, ways to do so is a practice known as payment for order flow. Payment for order flow allows commission-free trading, said Robinhood CEO Vlad Tenev during congressional testimony in February 2021 following a massive data breach. While everyday traders love the idea of zero commissions, the practice has come under fire from government regulators who say it can lead to suboptimal execution prices on orders and conflicts of interest for brokerages. The Securities and Exchange Commission, SEC, fined Robinhood $65 million in late 2019 for routing trades to market makers that didn't offer the best price, and also for misrepresenting what was happening. The issue isn't going anywhere. The SEC is currently investigating a handful of potential changes that could reform or even eliminate payment for flow. How popular these new rules will be with retail investors remains to be seen. What is payment for order flow? It used to once be very expensive to play in the stock market. Remember the dot-com bubble in 1998? In order to buy or sell shares of Pets.com, investors were typically paying $40 per trade. In the early 1980s, our average investor might have to spend $200 on a stock trade. Later, fierce competition among discount brokerages pushed trading commissions down. By the late 2010, many brokers no longer charged any trailing fees. Of course, these firms aren't operating charity organizations. They turned to payment of order flow to generate revenue, and when an investor submits an orders to buy or sell a share of stock, their broker passes it along to a third party who executes the trade and performs the transaction. This third party is known as a market maker and are large financial institutions that provide liquidity to the markets by both buying and selling stocks. The market maker pays the brokerage a small fee to fill the customer's order. Since the market maker is both buying and selling shares of stock, it can set its purchase and sale prices. A market maker buys shares of stock at lower prices than the prices at which it sells shares of stock, a difference known as a bid-ask spread. How does payment for order flow work? The more orders the market makers receive from Robinhood, the more profits they can generate from the spread. Brokerages make more money when they send more trades through them. Let's assume a market maker bought 100 shares of Nasdaq Apple stock from a retailer for $152.01 each, and then sold those shares to another retailer for $152.04 each. In this case, the market maker would lose just 3 cents per share. But market makers process billions of orders every single day. Market makers process these orders because they know that if they don't, brokers won't send them any more orders. So, why do we care about how much money market makers make? Because it encourages more active trading among retail investors. That means more orders for brokers to fill, and more fees for them to collect. Critics of the payment for order flow (PFOF) program say that customers don't pay for orders they place, and brokers make money off them. But the Securities and Exchange Commission says that PFOF doesn't violate any rules because it's not an offer or sale of securities. That means no one can sell something without paying for it. And if someone does, it's illegal. So why do people think PFOF is a scam? Robinhood failed to seek to obtain the best reasonably available terms when executing customers' orders, causing customers to lose tens of millions of dollars, said Joseph Sanson, chief of the SEC Enforcement Division's Market Abuse Unit. According to the SEC, Robinhood sold order flow directly to the market maker that provided the best rebate rather than to the broker that offered the best price. Meanwhile, the Financial Industry Regulatory Authority conducts examinations and audits to make sure brokers are meeting best execution requirements. According to FINRA Rule 5310, brokers must utilize reasonable diligence to determine the best market and execute orders at prices that are as favorable as possible under existing market conditions. The rule is intended to reduce conflicts of interest between brokers and customers. Regulators are taking a hard look at payment for order flow. Regulations governing payment for order flow could soon be strengthened. Last month, SEC Chair Gary Gensler said regulating payment for order flow was one of several areas being investigated to identify potential changes to markets to make them fairer and more transparent for retail investors. Payment for order flow can raise real issues around conflicts of interest, said Gensler. Certain principal trading firms seeking to attract Robinhood's order flow told them that there was a trade-off between payment for order flow and price improvement for customers. The SEC is currently investigating a new system of open and transparent marketplaces where traders can buy and sell stocks directly through the exchange without having to go through a broker. In addition, the SEC is proposing rules to make clear that brokers must act in the best interests of their clients, not just themselves. Finally, the SEC is working on rules to ensure that retail investors get fair access to information about the price they pay for stock trades. While there is a great deal of smoke right now, equity market structure reform remains in the very early stages. In fact, SEC Chair Mary Jo White hasn't even made any comments regarding a possible ban on payment for order flow. And while Jamie Cox, financial advisor for Harris Financial Group, says he thinks a ban is definitely coming, he doesn't think it will happen anytime soon. The SEC is going to have its hands full with oversight hearings in the next Congress, and that will backburner this issue, Cox said. The SEC will stick with less politically sensitive subjects like stable coins, crypto and failures to archive electronic messaging. The topic of whether payments for order flow are good or bad for retail brokers isn't an easily answered question, as well as being political. Dennis Dick, who trades retail and market structure analyst at Triple D Trading, expects the SEC will chart a middle ground focus on increasing disclosure about how retail orders are being processed, rather than eliminating payment of order flow out of fear that it may increase commissions. Right now, however, the SEC is still just in the idea stage, and there'll be no timetable when it concludes its research. Even when the SEC does implement new rules, there'd be a period of public discussion and comment before anything was implemented. Thank you for listening. Don't forget to subscribe and hit the bell.